Welcome, real estate enthusiasts and curious minds, to a captivating discussion on the housing market crash. Let's dive right in and get a sense of where we stand in this vast ocean we call the housing market. We all know that the real estate landscape is a living, breathing entity, constantly evolving and occasionally giving us a few surprises. Our current housing market is no exception. It's like a party that's been going on a bit too long. The music's still playing, but the snacks have run out, and some guests are starting to eye the exit. Now let's talk about housing prices. If you thought avocado prices were skyrocketing, wait till you hear about housing prices. They've been climbing faster than a squirrel on a mission, making it challenging for many to find affordable housing. It's almost as if the houses are playing a game of hard to get, isn't it? Next up on our radar are mortgage rates. These are like the heartbeat of the housing market. Currently, they're fluttering at historic lows, enticing more people to borrow and buy. But remember, what goes down must eventually come up. And when it does, we might just see a domino effect on the housing market. Lastly, let's touch on supply and demand trends. Right now it's like a game of musical chairs with too many players and not enough chairs. Demand is outpacing supply, pushing prices even higher. But when the music stops, will there be enough chairs for everyone? As we navigate through these choppy waters, it's essential to keep our sense of humor. After all, real estate, like life, has its ups and downs. And it's always a good idea to remember that every market, no matter how hot, eventually cools down. Now that we've laid the foundation, it's time to dig deeper. You might be wondering, what are the warning signs? What should we be looking out for? Well, let's dive right in. First and foremost, inflated housing prices are a key signal. When prices skyrocket beyond the reach of the average wage earner, that's a red flag. Think back to the mid-2000s, just before the last big crash. Housing prices were on a steep incline, making it hard for many to keep up. Today we're seeing similar trends in many markets around the country. Next up, keep an eye on those pesky mortgage rates. Historically, increased mortgage rates have often preceded a downturn in the housing market. Higher rates make it more expensive for people to borrow money to buy homes, which can lead to a decrease in demand, and eventually, a drop in prices. But it's not just about prices and rates. We also need to consider housing affordability. When a large portion of the population can't afford to buy a home, it's a sign that the market could be out of balance. Consider this. In the past few years, the number of people spending more than half of their income on housing has been steadily increasing. That's a situation that's not just unsustainable, it's a warning bell ringing loud and clear. And let's not forget the role of speculation. When investors start buying up properties with the sole intention of making a quick profit, rather than as a long-term investment, it can inflate prices and create a bubble that's ready to burst. But remember, these are just indicators, not ironclad guarantees. The housing market, like any market, is influenced by a multitude of factors, many of which are unpredictable. These are warning signs, not a prophecy, but forewarned is forearmed. To understand the future, we must first look at the past. Let's start this journey with a trip down memory lane to the Great Depression of the 1930s. A period marked by widespread unemployment and deflation. It was a time when the housing market took a nosedive. The cause, an overinflated stock market and reckless borrowing. The effect, homeowners were unable to pay their mortgages, resulting in a surge of foreclosures. Fast forward to the 1980s, a different decade, a different crisis. The savings and loan crisis this time. Deregulation led to risky investments and ultimately, the collapse of many thrift institutions. Yet again, the housing market was left in shambles with properties worth less than the loans that were taken out to buy them. Now let's jump to the more recent past. The housing crash of 2008. Remember that one? It was the result of a housing bubble created by risky lending practices, particularly subprime mortgages. When the bubble burst, home values plummeted, leaving millions underwater on their mortgages and leading to widespread foreclosures. Now you might be thinking, okay, but what does this have to do with today's market? Well, each of these crises shares common threads: overinflation, risky lending practices, and economic instability. Look around and you might see some familiar patterns. Overinflated home prices, check. Risky lending practices. With the rise of unconventional mortgage options, that's a check too. Economic instability, with a global pandemic still in play, that's a definite check. But despite these parallels, it's important to remember that history isn't a crystal ball. Just because something has happened before, doesn't mean it's destined to happen again in exactly the same way. But it does provide us with valuable lessons. Lessons that can help us spot potential red flags and navigate the uncertain waters of the housing market. History doesn't always repeat itself, but it often rhymes. So, let's keep our eyes and ears open for any familiar tunes. So, what happens if the housing market does crash? Who will be affected? Let's dive into the potential impact of a housing market crash. It wouldn't just impact homeowners or investors, but the broader economy too. To understand the gravity of such a situation, let's walk through some facts and figures. Imagine waking up one morning to find out that your house, the one you've invested your life savings in, is now worth less than the mortgage you owe on it. That's a reality many homeowners could face in a housing market crash. In fact, during the Great Recession of 2008, home values dropped by an average of nearly 30% nationwide, leaving millions of homeowners in a state of negative equity. Now let's shift our focus to real estate investors. They are often hit the hardest during a crash. As property values plummet, many investors find themselves unable to sell their properties at a profit. Instead, they may be forced to sell at a loss or hold on to properties that are no longer generating positive cash flow. But the impact of a housing market crash goes beyond individual homeowners and investors. It can have severe consequences for the broader economy as well. The housing sector is a major contributor to economic growth, accounting for approximately 15 to 18% of the gross domestic product. A significant downturn in the housing market could lead to job losses in construction, real estate, and other related industries, which in turn could trigger a recession. A housing market crash could also affect consumer spending. When people feel less wealthy because their home values have decreased, they're likely to cut back on spending. This phenomenon, known as the wealth effect, can further exacerbate an economic downturn. And let's not forget about the banks. During a housing crash, as more and more homeowners default on their mortgages, banks could face significant losses. This could lead to a tightening of credit conditions, making it harder for businesses and individuals to borrow money. In real estate, as in life, there are no guarantees, but knowledge is power. Now, the million-dollar question: how can you prepare for a potential housing market crash? Well, it's not as daunting as it might sound. Here are some strategies that could help you navigate the stormy seas of a potential crash. Firstly, diversifying your investments is a smart move. Don't put all your eggs in one basket, as they say. If the housing market does take a tumble, having your money spread across different investment vehicles can help cushion the blow. Consider investing in stocks, bonds, or even precious metals, alongside real estate. Secondly, securing low interest rates now can be a game changer in the long run. If you're looking to buy a property, locking in a low interest rate on your mortgage can potentially save you thousands of dollars over the course of your loan. Remember, a lower interest rate means lower monthly payments, which can be crucial during uncertain times. Thirdly, and perhaps most importantly, buy within your means. It can be tempting to reach for the stars when it comes to buying a house, but remember, the higher you reach, the harder you may fall. Buying a property that fits comfortably within your budget can help ensure that you're able to keep up with mortgage payments, even if the market takes a turn for the worse. So there you have it. Diversify your investments, secure low interest rates, and buy within your means. These strategies can help you prepare for a potential housing market crash and could be the difference between sinking or swimming in the choppy waters of real estate. Preparation is the key to success in any situation, including a potential housing market crash. As we wrap up, remember, the housing market is just that, a market, and markets have ups and downs. We've navigated through the landscape of the housing market, spotted the warning signs, looked back at history, gauged the potential impacts, and even discussed how to prepare. It's a complex world out there, but armed with this knowledge, you're one step ahead. So stay informed, stay prepared, and remember, every market downturn is an opportunity waiting to be seized. Don't forget to subscribe for more insightful videos, and leave a like if you found this information helpful. Here's to building wealth, one property at a time.